Every investor begins with a simple question. How do some people grow wealth calmly while others feel lost and stressed? The answer is not secret information or perfect timing. It is a way of thinking. This book is not about quick wins or daily excitement. It is about understanding how growth really happens over time. Growth investing is a quiet process that rewards patience and clarity. It asks you to slow down while the world rushes. Most people look at the market and see noise. A growth investor learns to see direction. Behind every successful investment is a strong belief in the future. That belief does not come from hope. It comes from understanding. Before choosing stocks or strategies, you must shape your mindset. The way you think will decide how you act when markets test you. Without the right mindset, even the best ideas fail. With the right mindset, simple ideas can succeed. This is why the journey starts inside the mind. The first chapter explores how a growth investor thinks, waits, and decides. Once the mindset is clear, the rest of the playbook begins to make sense. Chapter 1. The mindset of growth. Growth investing does not begin with charts or news. It begins with how you see the world. Two people can look at the same company and see different futures. One sees risk and uncertainty. The other sees possibility and progress. This difference comes from mindset. A growth investor believes that good businesses can become better over time. This belief is not blind optimism. It is built on observation, learning, and patience. The world keeps changing, and strong companies adapt to that change. They learn, improve, and expand. A growth investor learns to think the same way. Most people want fast results. They want proof today that their decision was right. This desire creates stress and poor decisions. Growth investing requires comfort with waiting. Waiting is not doing nothing. Waiting is trusting a well-thought-out decision. To build a growth mindset, you must accept uncertainty. The future is never clear. No one knows exactly what will happen next year or even next month. A growth investor does not try to predict every move. Instead, they focus on direction. Is the business moving forward? Is demand increasing? Is management learning from mistakes? This mindset removes the need to be perfect. You do not need to buy at the lowest point. You do not need to sell at the highest point. You need to stay aligned with long-term progress. Perfection creates fear. Progress creates confidence. A growth investor also understands time differently. Time is not the enemy. Time is the greatest ally. When a good business grows year after year, results multiply quietly. This process is slow at first and powerful later. Many people quit before the power shows. Patience is not passive. It is an active decision to ignore noise. Daily headlines are designed to trigger emotion. They create urgency where none is needed. A growth mindset filters this noise. It asks simple questions instead of reacting. What has changed in the business? What has changed in the long-term story? If nothing important has changed, then nothing important needs to be done. This calm approach protects both money and mental peace. A growth investor also respects learning. Markets are teachers, not enemies. Mistakes are feedback, not failure. Every decision improves future judgment. The goal is not to avoid mistakes completely. The goal is to avoid repeating the same ones. This mindset replaces fear with curiosity. Instead of asking, "What if I lose?" you ask, "What can I learn?" Instead of reacting emotionally, you observe thoughtfully. This shift changes everything. Another key part of the growth mindset is ownership thinking. You are not renting stocks for quick movement. You are owning parts of real businesses. These businesses have employees, customers, and long-term plans. When you think like an owner, short-term price swings feel less important. Owners care about quality. They care about leadership. They care about culture and vision. A growth investor looks beyond numbers and sees people and systems. Strong systems survive difficult times. Weak systems break under pressure. The growth mindset also values simplicity. Complex strategies often hide weak thinking. Simple ideas that are well understood work best. If you cannot explain why you own something in simple words, you do not understand it well enough. Clarity creates confidence. Confidence allows patience. Patience allows growth. A growth investor accepts that boredom is part of success. Excitement often leads to overtrading. Calm leads to consistency. Consistency builds long-term results. This mindset does not mean ignoring risk. It means understanding risk clearly. Risk comes from not knowing what you own. It comes from emotional decisions. It comes from chasing trends without understanding. The growth mindset reduces these risks naturally. You also learn to separate your identity from your investments. A bad outcome does not mean you are bad. A good outcome does not mean you are brilliant. This emotional distance keeps decisions rational. Over time, this way of thinking becomes a habit. You stop checking prices constantly. You stop reacting to every opinion. You start trusting your process. The mindset of growth is quiet, patient, and resilient. It prepares you for the long journey ahead. Before learning how to analyze businesses or manage money, you must master this mindset. Everything else in growth investing builds on this foundation. Chapter 2. Seeing businesses, not prices. Most people look at the market and see numbers moving up and down. They watch screens, charts, and daily changes. Their emotions follow these movements closely. When prices rise, they feel confident. When prices fall, they feel afraid. This habit creates confusion and stress. A growth investor learns to see something very different. They look beyond the price and focus on the business. A price is only a moment. A business is a living system that grows or weakens over time. Understanding this difference changes everything. Prices change every day for many reasons. News, opinions, rumors, and emotions all push prices around. Most of these reasons have little to do with the real strength of a company. Businesses change much more slowly. They grow customers, improve products, and build trust step by step. A famous investor once said that in the short run, the market is a voting machine, but in the long run, it is a weighing machine. This means prices reflect opinions today. But over time, prices reflect real value. Growth investors care more about weight than votes. To see businesses clearly, you must ask simple questions. What does the company sell? Who are its customers? Why do people choose this product or service? Is the problem it solves likely to exist for many years? Strong growth businesses usually have loyal customers. They do not rely on constant discounts or pressure. Customers return because they receive real value. This loyalty creates stable growth over time. Another important factor is revenue growth. Revenue shows whether more people are choosing the company each year. Rising revenue suggests expanding reach. But revenue alone is not enough. Growth must be healthy and sustainable. Profits matter because they show efficiency. A business that grows but never earns profits is fragile. A growth investor looks for improving profitability over time. This shows learning and discipline within the company. Cash flow is another powerful signal. It shows whether the business can fund its own growth. Companies that generate cash have freedom. They can invest, innovate, and survive difficult periods. Management quality plays a major role. Leaders decide how money and time are used. Great leaders think long-term. They avoid chasing trends that distract from the core mission. They communicate clearly and act consistently. A well-known growth thinker once said that the best companies are run by people who treat shareholders like partners. This mindset creates trust. Trust allows patience during temporary challenges. Seeing businesses instead of prices also means understanding competition. No company grows in isolation. Competitors try to copy success. Markets evolve and customer needs change. Growth investors study whether a company has an advantage. This advantage could be brand strength. It could be technology or scale. It could be deep customer relationships. The stronger the advantage, the longer growth can last. Many investors make the mistake of reacting to short-term price drops. They assume something is broken. Often, nothing has changed in the business at all. Only sentiment has shifted. Growth investors use price drops as moments to re-examine the business. They ask calm questions. Is the long-term story still intact? Are customers still buying? Is management still focused? If the answers remain positive, Patience becomes easier. Confidence comes from understanding, not from price direction. Another common mistake is falling in love with rising prices. A fast rising stock feels exciting, but excitement can hide risk. Growth investors avoid buying businesses they do not understand, even if prices are rising quickly. Seeing businesses clearly also means accepting uncertainty. No future is guaranteed. Growth investing is about probabilities, not certainty. You choose businesses that are likely to grow, not those promised to grow. This perspective removes the pressure to predict exact outcomes. You focus on direction, not precision. This makes investing calmer and more rational. Long-term success comes from aligning with real progress. Businesses that innovate, adapt, and serve customers tend to grow. Prices eventually follow this progress. When you stop staring at prices, time slows down. Decisions become less emotional. You begin to think like an owner, not a trader. This shift is essential for the chapters ahead. Once you learn to see businesses instead of prices, long-term thinking becomes natural. This prepares you for the true power behind growth investing, the power of time working quietly in your favor. Chapter 3: The Power of Long-Term Thinking. Long-term thinking is the quiet engine behind every successful growth investor. It is simple to understand, yet difficult to practice. Most people know that time creates growth. Few people have the patience to let time do its work. The world trains us to expect fast results. News updates arrive every minute. Prices change every second. Opinions are everywhere and always loud. In this environment, thinking long-term feels unnatural. Growth investing asks you to step away from this noise. Long-term thinking begins with accepting reality. Real growth takes time. Businesses do not transform overnight. Products need adoption. Customers need trust. Systems need refinement. All of this unfolds slowly. A growth investor understands that time is not the enemy. Time is the advantage. While others trade in and out, the long-term investor stays aligned with progress. This alignment allows compounding to work without interruption. Compounding is often described as a miracle. In truth, it is simply consistency multiplied by time. Small improvements repeated year after year create dramatic results. The challenge is that compounding feels invisible in the beginning. Early progress looks small and unimpressive. This is where many people quit too soon. Long-term thinking requires faith in process, not blind hope. It means trusting well-reasoned decisions, even when results are delayed. It means understanding that temporary silence does not mean failure. Markets regularly test this belief. There will be periods when nothing seems to work. Prices may move sideways for long stretches. At times, prices may fall even when the business is improving. These moments separate thinkers from reactors. The long-term investor asks different questions. What is the business building today that will matter tomorrow? Are customers becoming more loyal? Is the company learning from mistakes? Is the long-term vision still clear? Short-term thinkers ask only one question. Why is the price not moving? This question leads to frustration and unnecessary action. Long-term thinking also changes how you view mistakes. In the short term, mistakes feel painful and urgent. In the long term, mistakes become lessons. They improve judgment and discipline. Every experienced investor carries scars from early decisions. These scars are signs of learning, not failure. Another benefit of long-term thinking is emotional stability. When your time horizon is wide, daily movements lose power. A bad week feels smaller inside a long journey. This emotional distance protects decision-making. Long-term investors also understand cycles. Economies expand and contract. Industries rise and mature. Markets swing between optimism and fear. These cycles repeat because human behavior repeats. Instead of fearing cycles, growth investors respect them. They prepare for downturns before they arrive. They avoid overconfidence during strong periods. Balance becomes more important than excitement. Thinking long-term does not mean ignoring change. It means choosing which changes matter. Trends come and go. Real progress stays. Growth investors focus on deep shifts in behavior and technology. They ask whether a business is positioned to benefit from these shifts. If the answer is yes, they allow time to do the rest. Long-term thinking also improves decision quality. When you remove the pressure of immediate results, thinking becomes clearer. You are less likely to chase popularity. You are less likely to panic during uncertainty. This mindset creates an unfair advantage. Most people struggle to think beyond the near future. Those who can think in years instead of days face less competition. Long-term thinking requires discipline during boredom. There will be long stretches where nothing exciting happens. No headlines. No dramatic moves. Just slow progress. This boredom is not a problem. It is a signal that the process is working. Wealth is often built quietly, while attention is elsewhere. Another important aspect of long-term thinking is alignment with personal goals. You invest not to impress others, but to build a stable future. This clarity reduces comparison and envy. You stay focused on your own path. Long-term investors also learn to measure success differently. They do not judge progress by short-term gains. They judge it by consistency and improvement. Are decisions becoming better? Is understanding becoming deeper? Over time, this approach builds confidence. Not the loud confidence of prediction, but the quiet confidence of preparation. Long-term thinking does not promise certainty. It promises resilience. It does not eliminate risk. It manages it intelligently. When combined with the right mindset and business understanding, time becomes a powerful partner. Growth investing then feels less like a struggle and more like a journey. This chapter prepares you for the next step. Understanding how growth is measured and supported by numbers. When long-term thinking is in place, numbers stop being intimidating. They become tools that guide patience and discipline. Chapter 4. Understanding growth through numbers. Many people feel nervous when they hear the word numbers. They imagine complexity, confusion, and fear of making mistakes. Growth investing does not require advanced mathematics. It requires clear thinking and simple observation. Numbers are not enemies. They are storytellers. They reveal what is happening beneath the surface of a business. When read calmly, numbers explain growth better than headlines or opinions. The first number a growth investor observes is revenue. Revenue shows how much value a company delivers to customers. When revenue grows steadily, it means more people are choosing the business. This choice reflects trust and usefulness. Revenue growth over time suggests expansion. It may come from new customers. It may come from existing customers buying more. Both signals are positive. They indicate that the business is solving a real problem. However, revenue alone does not tell the full story. Growth without control can create hidden weakness. This is why profit matters. Profit shows whether a business can operate efficiently. It shows whether growth creates real value, not just activity. A company that learns to earn more while growing shows maturity. This maturity supports long-term success. Some young growth companies may not show strong profits at first. This is not always a problem. What matters is direction. Are losses shrinking? Is efficiency improving? Is management focused on sustainable progress? Cash flow is another critical number. Cash flow shows whether money is actually entering the business. Profits on paper are helpful. Cash in hand is powerful. Cash allows a company to survive storms and invest in opportunity. A business with healthy cash flow has flexibility. It can improve products. It can expand carefully. It can endure unexpected challenges. Debt is another number that deserves attention. Debt is not always dangerous. Used wisely, it can support growth. Used poorly, it can destroy it. A growth investor looks at whether debt is manageable. Can the company pay it comfortably? Does growth depend entirely on borrowing? Balance matters more than extremes. Margins offer deeper insight. Margins show how much of each sale becomes profit. Improving margins suggest learning and strength. Declining margins may signal rising competition or inefficiency. Strong growth companies often show stable or improving margins over time. This means they are not sacrificing quality for speed. Another important number is return on invested capital. This shows how effectively a company uses money to create growth. High returns suggest skillful management. Low returns may indicate wasted effort. Management behavior becomes visible through numbers. Decisions leave traces in financial statements. Wise leaders invest carefully. Reckless leaders chase growth without discipline. A famous investor once said that accounting is the language of business. Understanding this language allows investors to see clearly. Growth investors also compare numbers across time. 1 year alone means little. Trends reveal truth. Is revenue consistently rising? Are profits improving? Is cash flow becoming stronger? Consistency builds confidence. Sudden spikes demand caution. Numbers must also be viewed in context. A growing industry supports growth companies. A shrinking market makes growth harder. Comparisons within the same industry matter more than absolute values. Growth investing avoids obsession with perfection. No company has perfect numbers. What matters is direction and quality of improvement. Another mistake many investors make is reacting to short-term changes. A single weak quarter can trigger fear. Growth investors step back. They ask whether the long-term trend remains intact. Numbers should guide decisions, not dictate emotions. They support thinking. They do not replace judgment. Understanding growth through numbers builds confidence. It removes mystery. It turns uncertainty into probability. With practice, numbers become familiar. They stop feeling cold and distant. They become tools that support patience. This chapter completes the foundation of growth understanding. Mindset shapes behavior. Business insight shapes focus. Time creates power. Numbers provide clarity. With these elements combined, you are ready for the next challenge. Learning how to manage risk while pursuing growth. This balance separates lasting investors from temporary winners. Chapter 5. Managing risk while pursuing growth. Growth investing is often misunderstood as reckless or aggressive. In reality, successful growth investors respect risk deeply. They know that growth without protection can disappear quickly. Managing risk is not about avoiding opportunity. It is about surviving long enough for opportunity to work. Risk begins with uncertainty. No one knows the future with certainty. Markets change. Technology evolves. Customer preferences shift. Growth investors accept this reality instead of fighting it. The first step in managing risk is position sizing. This means no single investment should control your future. Even the best ideas can fail. Spreading capital across several strong businesses reduces damage from mistakes. Diversification is not fear, it is wisdom. Another key element of risk management is understanding what you own. Risk increases when you invest without clarity. If you cannot explain how a company makes money, risk is high. If you do not understand why customers choose it, risk is high. Knowledge reduces uncertainty. Growth investors also avoid chasing stories. Exciting narratives can hide weak fundamentals. A good story feels convincing. A good business proves itself over time. Risk grows when emotion replaces analysis. Valuation plays a quiet but important role in risk. Paying too much for growth increases downside. Even great companies can become poor investments when bought at extreme prices. Growth investors respect future potential, but they also respect reality. Another source of risk is concentration in one sector or theme. Industries rise and fall in cycles. Regulation changes. Competition increases. Spreading exposure across different areas reduces surprise. Risk is also connected to time horizon. Short time frames amplify risk. Longer time frames smooth volatility. Growth investors extend time to reduce pressure. Emotional risk is often the most dangerous. Fear causes panic selling. Greed causes overconfidence. Both destroy discipline. Growth investors prepare emotionally before markets test them. They create rules during calm periods. These rules guide action during stress. This preparation protects against impulsive decisions. Another form of risk is ignoring warning signs. Not every problem should be ignored. Growth investors distinguish between noise and signal. Temporary issues are common. Structural problems require attention. Examples of serious risk include declining customer loyalty, loss of competitive advantage, poor capital allocation by management. When these appear, reassessment is necessary. Growth investors do not cling blindly to investments. They stay flexible. Flexibility is strength, not weakness. Cash also plays a role in risk management. Having some liquidity provides comfort and opportunity. It allows patience during downturns. It allows action when others are forced to sell. Risk management does not eliminate losses. Losses are part of investing. What matters is size and recovery. Small losses are manageable. Large losses are destructive. Another powerful risk reducer is continuous learning. Markets evolve. Strategies must adapt. Growth investors study mistakes and improve process. Learning compounds just like capital. Risk management also involves avoiding complexity. Simple strategies are easier to follow under stress. Complex systems often fail when pressure rises. Clarity supports consistency. A growth investor accepts that uncertainty never disappears. Instead of seeking safety, they seek resilience. Resilient portfolios bend, but do not break. Managing risk allows growth to unfold naturally. It keeps emotions steady. It protects capital. It preserves opportunity. With risk under control, the investor gains confidence. Not confidence from prediction. Confidence from preparation. This balance between caution and optimism defines mature growth investing. It prepares you for the next challenge. Understanding the role of emotions and behavior in long-term success. When risk is managed wisely, the mind remains clear during market storms. Chapter 6. Emotions and the Growth Investor. Emotions are always present in investing. They arrive quietly and influence decisions before logic has time to respond. Many people believe investing is a numbers game. In reality, it is a psychological journey. Markets are designed to test emotional limits. They rise when confidence feels highest. They fall when fear feels unbearable. This pattern repeats again and again. The growth investor learns to recognize this cycle. Fear often appears first. It whispers that something is wrong. It urges quick action. It demands certainty in an uncertain world. Fear feels protective, but it often causes harm. When prices fall, fear magnifies loss. It turns temporary declines into permanent mistakes. Many investors sell good businesses because discomfort feels unbearable. The growth investor pauses instead of reacting. Greed is fear wearing a different mask. It appears during strong markets. It convinces investors that growth is guaranteed. It encourages larger risks and weaker discipline. Greed pushes people to chase what is popular. Both fear and greed distort perception. They narrow focus and shorten time. They replace thinking with impulse. The growth investor trains the mind to slow down. They understand that emotions are signals, not commands. Feeling fear does not require action. Feeling excitement does not require agreement. Emotional awareness becomes a skill. You observe what you feel without judgment. You ask why the emotion appeared. You return to facts and process. A powerful emotional tool is preparation. Decisions made during calm moments guide behavior during stress. Rules created in peace protect you in chaos. Writing down investment reasons is one such rule. When markets shake confidence, written clarity restores balance. You remember why the investment was made. You revisit assumptions instead of reacting to noise. Time also softens emotional intensity. When you think in years, daily swings lose power. Short-term pain becomes manageable inside a long journey. Distance creates perspective. Another emotional challenge is comparison. Seeing others succeed quickly can create doubt. You wonder if you are too slow or too cautious. Comparison steals focus and confidence. Growth investing is personal. Your goals are unique. Your time horizon is your own. Success does not look the same for everyone. Learning to ignore crowd emotion is difficult. Markets amplify group behavior. Optimism spreads fast. Fear spreads faster. Standing apart requires courage and clarity. The growth investor learns to be comfortable with being early or quiet. Often the best investments feel boring at first. They lack excitement and headlines. This boredom is a form of emotional protection. Another emotional trap is attachment. Investors sometimes tie identity to investments. A stock becomes part of who they are. This attachment clouds judgment. Growth investors separate self-worth from outcomes. A losing investment does not define character. A winning investment does not prove superiority. This separation keeps the mind flexible. Loss is inevitable. Every investor experiences it. Avoiding loss completely is impossible. Learning from loss is essential. Emotional maturity means accepting loss without self-blame. You study what happened. You improve process. You move forward without resentment. Stress management also matters. Constant market watching increases emotional fatigue. Growth investors limit noise. They choose when to check prices and news. Silence creates clarity. Another emotional strength is gratitude. Recognizing progress builds patience. Acknowledging learning builds confidence. Gratitude reduces the urge for constant action. Markets reward consistency more than intensity. Emotional steadiness supports consistency. It allows good decisions to compound over time. The goal is not to remove emotion. That is impossible. The goal is to prevent emotion from controlling action. With practice, emotional discipline improves. Reactions slow. Confidence deepens. Decision-making becomes calmer. This emotional foundation supports long-term success. It protects growth during difficult periods. It allows patience to survive uncertainty. When emotions are understood and managed, investing becomes clearer. The final step is combining all lessons into a lasting personal system. A system that supports growth through every market environment. Chapter 7. Building your personal growth playbook. Every lesson in this book leads to one purpose: helping you create a personal system that works through time. Without a system, emotions take control. With a system, decisions become calmer and clearer. A personal playbook is not complex. It is simple, honest, and repeatable. It reflects who you are and how you think. It protects you when markets test patience and confidence. The first step in building your playbook is clarity of purpose. You must know why you are investing. Is it freedom, security, peace of mind, long-term growth? When purpose is clear, distractions lose power. Many investors struggle because their goals are vague. Vague goals lead to inconsistent behavior. Clear goals create discipline. They guide decisions when uncertainty appears. The next step is defining what kind of growth investor you want to be. You do not need to copy anyone else. You need a style you can live with. Some investors prefer steady growers. Others accept more volatility for higher potential. Your temperament matters more than theory. A good playbook respects personality. If a strategy causes constant stress, it will fail. If it supports calm thinking, it will last. Your playbook should clearly describe how you choose businesses. What qualities must a company have before you invest? Strong growth, real products, trusted leadership, financial discipline. These rules act as filters. Filters reduce noise. They prevent impulsive decisions. They protect time and focus. Another important part of the playbook is position size. Decide in advance how much capital any single idea can receive. This rule protects you from overconfidence. It ensures no mistake becomes catastrophic. Your playbook must also include rules for review. How often will you check your investments? What signals matter? What signals can be ignored? Without review rules, emotions take control again. Reviews should focus on business progress, not price movement. Are customers growing? Is revenue expanding? Is management acting responsibly? These questions matter more than daily fluctuations. You also need rules for action. When will you add to an investment? When will you reduce exposure? When will you exit completely? Decisions made in advance reduce emotional pressure later. One wise investor once said that the biggest enemy of good investing is not ignorance, but emotion. A playbook is protection against this enemy. Your playbook should include rules for learning. Markets evolve. Businesses change. Your understanding must grow too. Set time for reading, reflection, and review. Mistakes deserve special attention. Every mistake should be studied calmly, not with anger, not with regret, but with curiosity. Each mistake contains a lesson that improves the system. Another important section is behavior during market stress. Write down how you will respond during fear. Will you pause? Will you review fundamentals? Will you avoid impulsive selling? These reminders matter most when clarity is hardest. The playbook should also address success. Strong markets create overconfidence. Write rules that prevent reckless behavior during good times. Growth investing fails when discipline disappears at the top. Your system must also allow flexibility. No rule is permanent. Markets change. Your life changes. Review the playbook periodically. Refine it with experience. Simplicity is essential. A complex system is hard to follow under pressure. Simple rules survive stress. They are easier to trust and repeat. Another powerful element is patience measurement. Instead of tracking short-term gains, track consistency. Are you following your rules? Are decisions becoming calmer? Is understanding improving? These signs matter more than short-term returns. Your playbook should also include boundaries. How much time will you spend watching markets? How much news will you consume? Noise weakens discipline. Boundaries protect focus. A growth investor learns that doing less often achieves more. Fewer decisions, better decisions, longer holding periods. This approach supports compounding. Confidence grows slowly through repetition. Each cycle builds trust in the system. Over time, doubt weakens. Clarity strengthens. The personal growth playbook is not about control. It is about alignment. Aligning mindset, behavior, and time. When alignment exists, investing feels lighter. Less reactive, more intentional. You stop fighting the market and start working with it. Growth investing then becomes a journey, not a battle. A process, not a prediction. A partnership with time, not a race against it. This playbook does not promise certainty. It offers direction. It does not remove risk. It manages it wisely. Those who succeed are not the smartest. They are the most consistent. They respect patience. They respect discipline. They trust process over emotion. When you build and follow your personal playbook, growth becomes sustainable. Not just in wealth, but in confidence and clarity. This is the true goal of the growth investor. To grow capital steadily. To protect peace of mind. To let time work without interference. With this final chapter, the playbook is complete. What remains is practice. Quiet, patient, and consistent action over time.